What's up, guys? Omar, broker and CEO of Alden Mortgage and Omar Realty. So a question that we get asked a lot is like, hey, do I just get a home equity line of credit? Is there only one type of home equity line of credit? Or do I do a cash out refi? Well, personal, okay? Now, disclaimer, this is all for informational purposes only and all that other blah, 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 equal housing opportunity lender, NMLS ID number. All disclaimer is down below. But if you do need assistance with any of them, please feel free, apply below. We'll be more than happy to try to help you out as much as you can. This is not a promise to lend, but let's try to figure out exactly what the difference is between a home equity line of credit and what the cash out refi, and then you can make the decision all based on your own little merry way. So what is a home equity line of credit? Okay, to make it very, very simple, a home equity line of credit is like a big old credit card. That's all she is. You don't need to take any money out. You could have a home equity line of credit and then just let it run for the whole entire 10 years and never pull anything out and call it a day. But here's a few things that people don't tell you about home equity line of credits that you should know. So home equity line of credit, loan to value, those change all the time, okay? Typically it's about 80% loan to value. The cash out, you will usually have what's called a teaser rate, which means that you have initial draw period. Now this is for them as lenders, myself included. We are able to give you, the consumer, an ability to get a lower teaser rate, which sometimes is 2.5%, sometimes it's 2%, depending on the time that you're getting it, and you know, your credit scenario and everything like that. There's a lot of things that go along with it. We're more than happy to help you out if you do need any assistance with it. But you would have to have, like, let's say a $50,000 draw. A draw period, which will be from year 1 through 10. So it was 0 to 10. Because you're going to go ahead and apply for it. And then the first year we'll go ahead and start clicking over. Now, what is a draw period? A draw period is the amount of time that you could go ahead and pull money out of your home equity line of credit to use it whatever you can, and you will only be paying interest. There are different ones, so I'm giving you a very generic one right now. Which is a very common one. A lot of banks do this. So mind you, there are different types of it. I'm just going to go with the most generic one, which most big box retail banks do, and most of the ones that we do. So you have your draw period, which goes from 1 to up to 10 years. Now your draw period will only be interest only. There is a fixed rate one as well, but it does not have a teaser rate and usually is accompanied by a higher rate. But we're gonna, for the sake of argument, we're just gonna go ahead and stick with the one most people get. Now you have your fixed teaser rate. Now your teaser rate just like entices you to go ahead and pull out 50,000, 100,000, whatever the teaser rate criteria is. So they'll say, okay, you could do 2.49%, that's your teaser rate, and then after that, after the first year, it's going to go to 3.5%. Then we'll keep that locked in until the 10-year period. So you have 10 years locked, interest only. But then here's the kicker: if you don't have everything paid by that 10 years, then it does go to an adjustable rate mortgage, which you don't want. You never, ever, ever want to get it, because then you're just at the mercy of the market. Now the good thing is that there is a cap on each year that it's able to go up. And of course I can't give you an exact number because everybody's situation is different, every lender is different. There's a bunch of things that happen that you really don't have to worry about. So for that first 10 years, you could pull out as much cash as you were qualified for. You could go ahead and pay it back. You're only paying the minimum payments on it, so that kind of helps out in a way. But you want to make sure that you don't overextend, because you will ultimately go into what we go ahead and call the cash out refi. Now, the good thing about the home equity line of credit is that if you don't use it, you don't need to go ahead and do anything with it. You don't carry that balance later on, which a lot of people like it, which is cool. You know, you don't have to carry, like if you did a cash out refi, you get a lump sum amount. So let's go ahead and go to cash out refi, and then we'll compare the two. So a cash out refi is exactly that. Your loan to value is going to be somewhere between 75 and 80%, depending on your credit. depending on the lender we sell it or the wholesaler that we sell it to. There's a bunch of different companies out there, so everybody has a little bit of a different guideline to what they're able or willing to do a cash out refi. Fannie Mae and Freddie Mac, which are the two biggest insurance companies out there, they're corporations, they're owned by individually. They do, I think we're at 75 with them right now. But of course it could change any time. You know, everybody's a lot different. But when you do a cash out refi, right? You have your home. Your home is worth X amount of dollars. I am going to pull the equity that I built out of that home and I'm going to go ahead and pocket it. So let's say for the sake of argument, you owe $500,000 on your home and your house is worth $1 million. You want to take that $300,000, pull it out, you're going to pocket that $300,000 and then you're going to do it for whatever like if you are going under the BRRRR method and you are just doing the buy, repair, rent, refinance, but this will actually work out really, really well for you because you're more worried about the ARV than anything else and you want to go ahead and get your next property. But for the most part, most consumers are not investors. You're just doing this for yourself. You want to pull out some money to go ahead, I don't know, go on a vacation or fix up a house or whatever you want to go ahead and do. The bad part about a cash out refi is that you are going to hold that extra amount that you're going to pull out and it's going to be put in your pocket, and then that is a balance. It's going to be a debt on your credit, on your home, and you're going to have to pay interest on the total amount. So for instance, the $500,000 to $1 million mark, if you pull out $300,000, now you're going to be paying principal and interest, tax, and insurance on $800,000 rather than whatever your initial loan amount was when you first got your note. The good thing is that will be the same all throughout the 30 years. You don't have to worry about it going up. You don't have to worry about it going down. If you got it fixed, there are other options where you can go ahead and do an adjustable. You could go ahead and get an IO loan. You can do whatever. And of course, cash out refinances do change depending on occupancy type. Whether it's your primary second, whether it's an investment, it's a non-owner occupied. Everybody's going to be a little bit differently. So remember, all the information I'm giving you, it's just, take it with a grain of salt because everybody's a little different. But for the most part, cash out refis, you're going to hold that balance and then that's going to go ahead and go from there. If it's your only house and you're not using this to invest and you're not using it to go ahead and acquire your next property, then you might want to remember that even though you're pulling that $300,000 out, maybe that $200,000, $100,000, whatever, you are going to hold on to it and you're going to have to pay for the rest of the term that you're going, unless you do, you pay it off earlier. Now, as far as home equity line of credit, if I got a $300,000 home equity line of credit, I only used about $50,000 and I was able to pay that all back, most of it, let's say before the 10 years. And even if after my 10 years is up, I only have $15,000, $20,000 in a home equity line that I have to go ahead and pay. It's not that bad. It's better than paying P&I, principal and interest on $300,000. But it depends on what situation that you're in. It depends on where you're trying to go. But for the gist of it, home equity line of credit. Think of it, big credit card. I could go ahead and spend it and I don't have to spend it if I don't want to. Cash out refinance, I have to take the whole entire cash and I owe all of that money back to the man. I hope this content helped you out a little bit. If you need any assistance with any type of lending, of course, link in the description below. We'll help you out whatever we can, yada, yada, yada. Equal housing opportunity lender. This is for informational purposes only, but we are here to help. That's the only reason why I'm doing this, and also to help people out. If it helped you out, please like, subscribe, comment, do all of that stuff. And if you want me to talk about anything else, I'm going to have a bunch of videos out based off of lending products that we have. And you could go ahead and just start scrolling through all of these videos that we have, but it'll help us out a lot if you could go ahead and like, subscribe. I also have this other show. I guess do you even call it shows when you're doing it on YouTube when I'm doing it myself? But we do tacos and mortgages where we just go review tacos. I mean, if you like that, you can watch. Thank you for watching. Appreciate it. Hopefully it's entertained you a little bit. Hopefully I made an ass out of myself and I kind of made you laugh or whatever. But if it helped you, link in the description below. Till next video, guys. Thank you for watching.